For more insight on the investment situation in China, I spoke to Scott Kennedy. He's the director of the Project on Chinese Business and Political Economy at the think tank CSIS. And I asked him about all this foreign direct investment and why it's important to the economy.
There's lots of ways that money crosses borders between countries. Foreign direct investment is the way that we most easily would understand the way that one company directly invests in other companies that are already operating, or they open up their own new factories or operations on the ground, and that money is counted as foreign direct investment. It's different if they were to buy stocks or bonds. That would be foreign investment, but it wouldn't be foreign direct investment.
So it's company to company, not government, not people to people. It's
correct.
Corporations.
Correct.
That leads us to China. There's been an awful lot of focus on FDI ever since I've been following China for the past 15 years. What is the health of foreign direct investment today in China?
China is a large country, and it is a big recipient of foreign direct investment. It's the largest recipient of foreign direct investment of any developing country, and it's right up there with anybody else, including the United States. And that investment goes into all sorts of things, primarily manufacturing. Originally, it had gone into manufacturing as part of these companies' using China as an export platform to sell their products all around the world, so it's just a small link in a long chain. Now, most of that investment is in China to sell into the Chinese market. So, for example, 85% of American companies that are in China for the Chinese market.
That brings up an excellent point, because I was going to say that history tells us that China is the factory of the world. Today, it's much different. They're trying to push domestic consumption. They're trying to push to have more factories within China, and they're building different things, right? They're not making T-shirts and shorts anymore. They're making high-tech goods, and you can argue, on which side it's on. The bottom line, though, is that they are making more valuable goods. And this trend that we see on foreign direct investment, how does that impact that? Are we likely to see a higher dollar figure?
Foreign direct investment going into China has been high for a long time, since the mid-90s, and with China's entry into the WTO, jumped up even further. The first half of this year was about $53 billion US altogether, about 10% over 2014. We should continue to see the gradual rise of it because the Chinese economy is growing, consumption is growing, the opportunities for foreign companies are gradually expanding as China goes through its own types of economic reform. But the real action, where the real change is coming, is in the amount, the scale of Chinese outward foreign investment. That is already surpassing inward foreign investment, and over time is going to way out, fly right by it.
There's been a lot of talk about a potential proposal or bid, I should say, from Micron Technologies. I just want to get your thoughts. I mean, if that were to come true, that would be the largest acquisition of a U.S. company by a Chinese entity, essentially. Is this the beginning, or are we in the middle? Where are we in the cycle?
I would say in the middle of stage 2 of Chinese outward investment. The first stage, the last decade, was investments in raw materials, commodities, oil, things that would be sent back to China and feed the manufacturing machine and Chinese infrastructure growth. We're now in phase 2, which is the Chinese outward investment in manufacturing, energy, high-tech, things which technologies and capabilities that the Chinese don't have, or gets them access to markets that they wouldn't have had as easily accessed from China. We are at an inflection point. I think if we're going to start phase 3 pretty soon, because as China's economic reforms change, and China's goal to avoid the middle income trap is to raise where China sits in the value-added chain globally. Part of that is about improving the efficiency, productivity of Chinese companies in China, and at the same time taking those areas of the Chinese economy where China had comparative advantage, but where there's lower profit margins, and offshoring those. The same process the U.S. went through in the 1960s and 70s, and that we've seen again and again around the world. That trend is going to accelerate and we're going to see a lot more investment around the world in Asia and other parts of the globe.